What if you could buy a home today and keep the seller's ultra-low interest rate from years ago? In the right situation, that's not a loophole. It's a real financing option most buyers don't understand. I'm Jermaine, your Arizona realtor, lender, and fellow investor. And in this video, I'm breaking down assumable loans, how they work with FHA, VA, and USDA financing, and when this strategy can save buyers and sellers serious money. Have you heard of assumable loans? These are mortgage loans you can take over, rate, term, and all, from the current homeowner. That means if someone locked in a 3% interest rate in 2020, you might be able to assume that same rate today instead of starting over at 7%. This is real, and it can be powerful. Meet Jen and Alex. They're shopping for homes in Tempe and find a listing where the seller has a VA loan at 2.75%. Their lender confirms it may be assumable, and suddenly this home jumps to the top of their list. So let's break it down. FHA loans are assumable, but the buyer must qualify with the lender. That means credit, income, and debt to income still matter. FHA mortgage insurance usually stays in place too. VA loans are also assumable, even by non-veterans. That's a big deal. But sellers need to be careful. If the buyer isn't a veteran, the seller's VA entitlement may stay tied up, which could limit their ability to use a VA loan again until it's restored. USDA loans, typically used in rural areas, can also be assumable. But depending on equity and income, subsidy recapture may apply. This is where working with the right lender matters. So why do buyers love assumable loans? The interest rate. Locking in 3% instead of 7% can mean hundreds, even thousands, saved every month. In today's market, that difference can turn maybe into we're buying. Sellers win too. Advertising an assumable FHA, VA, or USDA loan, especially at a low rate, can attract more buyers, generate stronger offers, and shorten days on market. But there's a catch. The buyer still has to qualify, and if the loan balance is far lower than the home's value, the buyer may need to bring cash to closing or secure a second loan to cover the difference. Jen and Alex ultimately assumed a VA loan on a home in Chandler. Compared to a traditional mortgage, they saved over $1,000 per month and still closed in under 30 days.
Can investors assume government loans? Can sellers use a second loan to access equity?
These are smart questions. And the truth is, assumable loans are one of the least known but most powerful tools available to Arizona buyers and sellers right now. If you have any other questions about assumable loans, let's talk. I'm always here to help homeowners and future homeowners like you. Got questions? Call or text me at 480-800-HOME. And don't forget to like, comment, and subscribe for more Arizona real estate tips. Have a nice day.